Our next guest says that things have gone from Tina, remember, there is no alternative, to Tira. There is a reasonable alternative. Joining us right now to talk about what that means is Keith Banks. He's Vice Chair and Chief Investment Officer of the Pension and Benefits Plan at Bank of America. And Keith, walk us through this. You are neutral right now on both stocks and bonds because there are other alternatives. What are you looking at?
So when we came into the year, Becky, we saw a couple things coming. Number one, we thought we'd be moving into the late phase of the economic cycle, and ultimately that would lead to weaker economic growth, ultimately a recession with that lower earnings. Rates would continue to rise to deal with inflation. So for us, the right way to come into the year was to be neutral, as you suggest, both equity and fixed income. We're still there. From a sectoral standpoint, we were defensive, so we liked utilities, healthcare, energy, names like that, or sectors like that, and we continue to be in that position. Tira.
There is a real estate. Oh, Tira, yeah.
We're Tira, not Tierra. But
T-I-E-R-A. You're just saying it.
Right. So there is a reasonable alternative.
T-I-E-R-A, Tierra.
As Becky said. And the reasonable alternative is fixed income. I mean, you've got, and you were talking about just a couple minutes ago, right? So you've got 2-year yields, 4.8, almost 4.9%. You've got the 10-year over 4%. So we look at fixed income, short-term fixed income, we look as a great way to generate income. And the long end, ultimately, we think there'll be a good opportunity for total return.
Okay. One of the things people wonder is what's fair price for the market. And I think you're looking at 4,000 on the S&P as kind of the equilibrium point right now. That's where we are. What's the range on either side?
You know, there's some people that are more negative than we are who expect the markets to get back down to 3,000, 3,300. We're looking at a range of, and again, this sounds more precise than it is, but call it 3,700 to 4,200. 42 is kind of where the market peaked not too long ago. Could you see us go back to the lows of October of last year, which was 35? Sure. It's all going to depend on how much further the rates go, obviously. What does that do to the economy? We're still forecasting as our base case, Becky, a recession starting in the third quarter of this year. Not a dramatic recession, -1% in the third quarter, -2% in the fourth, and then maybe 0.5% negative in the first quarter of next year. And then we slowly come out of it. So with that, we think earnings forecasts and estimates will continue to come down. We're at 200 right now, B of A Global Research. I think the consensus is still around 224. So we think that's going to put some pressure on the markets as well. So our view is markets go lower before they go sustainably higher, and we'll have an opportunity to put cash to work at lower levels. You
were neutral on stocks at the beginning of the year. January was a pretty strong month. What happened there?
You know, I think there's a number of factors. Number one was the fear of missing out. You know, we saw an 18% rally from the lows, 3,500 roughly in October up to the peak. And I think when the market started off in a good way, people got nervous that it was going to continue. So you had that going on. You had a lot of short covering, end of very aggressive tax law selling, and some of the technical indicators turned positive, and that drives some of the momentum players. So I think the combination of all of that, not to mention that most strategists were saying we're going to start weak and then strong. So, of course, we started strong, and, we're going to deal with it from there.